Before Wall Street, before the New York Stock Exchange, there were medieval merchants trading fortunes across the seas. But how did ordinary traders create the world's first stock market, centuries before modern capitalism even existed?
Welcome to Medieval Finances, as we take a ride down memory lane and examine how trade, risk, and money evolve into the capitalist system we know today. And by the end of this video, we will see how capitalism's DNA began in medieval Europe. Now, imagine a world where wealth isn't counted in credit cards, digital wallets, or online trades, but in ships filled with spices, gold, and silk. A world where the risk of the open sea could make or ruin a fortune overnight. Before Wall Street, before the London Exchange, there was a very different kind of trading floor. It was noisy, chaotic, and revolutionary. This was the birth of capitalism. Centuries before the modern age, the idea of a stock market first took shape, long before the world even had the word stock. And it all began not in New York or London, but in the cobbled streets of Venice, Bruges, and Amsterdam. How did medieval merchants, sailing across dangerous seas and trading with distant kingdoms, invent a system that allowed others to invest in their voyages? Why did kings, popes, and peasants alike become entangled in the webs of early financial speculation? And perhaps the biggest question of all, how did these early experiments with risk, debt, and profit set the stage for the economic world we live in today? Because long before modern brokers wore suits, medieval merchants wore robes, rings, and ambition. They were innovators, gamblers, and visionaries, turning trade into investment and investment into power. Let's start in Venice, the glittering city of canals and commerce. It was here, in the 11th century, that the first seeds of organized trade began to bloom. Venetian merchants built fortunes by financing fleets that carried goods from Constantinople, Alexandria, and beyond. But ships were costly, and the seas were treacherous. So merchants came up with a radical idea: shared investment. They sold portions, or shares, in a voyage. If the ship returned safely, everyone profited. If it sank, the loss was shared. It was risk divided, and for the first time in history, profit could be multiplied through partnership rather than personal wealth alone. This wasn't just smart economics. It was the beginning of collective investment, a cornerstone of capitalism. And though it may not have been called a stock, it worked in much the same way. Meanwhile, up north in Bruges, part of modern-day Belgium, another revolution was brewing. Bruges became the beating heart of European finance in the 13th and 14th centuries. Here, Italian bankers met English wool traders and German merchants in crowded squares and candlelit taverns. And among these gatherings stood a house, owned by a family called Vanderburgs. This house became so famous for hosting trading meetings that the word bourse, meaning exchange, was born from their name. Centuries later, we still use it: the Paris Bourse, the Brussels Stock Exchange. What began as a few merchants scribbling agreements on parchment soon evolved into a network of international finance, complete with contracts, debt notes, and early versions of bonds. But not everyone welcomed this new financial order. The church condemned the charging of interest, calling it usury. To profit from money itself was seen as sinful. Yet, as kingdoms needed gold for wars and trade, even the clergy found creative loopholes. So while the church preached virtue, its monasteries often acted as silent investors, lending to merchants through intermediaries. In a way, religion and finance became strange bedfellows, each using the other to expand influence and control. This moral tension between profit and principle would haunt financial history for centuries and still echoes in the way we debate capitalism today. Then came the 16th century, the dawn of true global trade. Empires discovered new worlds. Ships grew larger, voyages longer, and the stakes higher than ever. No single merchant could finance a fleet capable of crossing oceans, so investors from all over Europe pooled their money to fund massive expeditions.
and thus emerged the joint stock company, the ancestor of every modern corporation. The Dutch East India Company, founded in 1602, became the world's first publicly traded company. Investors bought and sold shares, dividends were paid, and fortunes rose and fell with every voyage. But even before the Dutch formalized it, the concept was centuries old, born in the imagination of those daring medieval merchants. It's easy to think of the stock market as a modern invention, born of skyscrapers, screens, and stock tickers. But its DNA is ancient. It comes from a time when risk was measured in tides, not algorithms, when investment meant trusting a ship to return from the edge of the world. The medieval marketplace was the crucible, the testing ground where the principles of modern finance were forged. Partnership, speculation, profit, loss, and the eternal drive for expansion all began here. So as we trace the path from Venetian docks to Dutch trading halls, we're really tracing the evolution of human ambition itself. The idea that money could grow not from labor alone, but from imagination, collaboration, and risk. Because the story of the first stock market isn't just a story about merchants or money. It's a story about how humanity learned to trade its dreams for a share of the future.
As Europe's trade routes expanded, so too did its hunger for gold, not just to spend, but to move. Coins were heavy, roads were dangerous, and trust was rare. And in that challenge, a new kind of power quietly emerged: the merchant banker. These were not kings or soldiers. They carried no swords, commanded no armies. Yet with a stroke of a quill, they could fund wars, rescue monarchs from bankruptcy, and shape the destiny of nations. Their power came not from the land, but from credit, the invisible currency of trust. In the bustling cities of Florence, Venice, and Genoa, families like the Medici, Fugger, and Barbadori began to redefine what money could be. They were merchants first, dealing in wool, silk, and spices, but soon realized that lending money could be far more profitable than selling goods. And so trade evolved into finance. Where once ships carried pepper and pearls, now caravans carried promissory notes, pieces of paper representing fortunes in motion. These merchant bankers became the architects of a new world, one built not on gold, but on confidence. They created bills of exchange, documents that allowed merchants to transfer money across borders without carrying a single coin. A trader in Bruges could pay a banker in Florence, who would then issue payment to his partner in Venice, all through ink and reputation. It was revolutionary, the beginning of international banking. But this new power came at a cost. For every wealthy banker, there was suspicion. To many, money lending still carried the stench of sin. Yet kingdoms, even the Vatican, needed their services. When popes needed armies, when monarchs needed ships, when empires teetered under the weight of debt, it was the merchant bankers they turned to. The irony was striking. The same church that condemned usury relied on the very men it denounced. And those men, clever, strategic, and patient, learned how to make this system serve them. They funded crusades, minted coins, and collected tithes on behalf of Rome. And in return, they received influence, not on battlefields, but in back rooms, where decisions were made with ink instead of iron. The Medici family became the most powerful of them all. From humble beginnings as cloth merchants, they rose to control the flow of Europe's money. They financed artists, builders, and popes, and in doing so transformed Florence into the beating heart of the Renaissance. To them, banking was more than business. It was art, the art of managing risk, reputation, and reward. Each transaction was a step towards something greater: stability, influence, and immortality through legacy. By the late 14th century, merchant bankers had become the hidden kings of Europe. Their wealth could topple dynasties or save them. Their ledgers held secrets more valuable than any crown jewel. And yet, for all their sophistication, their methods were still rooted in the same principle that drove the first medieval merchants: shared risk. Each loan, each partnership, each voyage was an investment. Every success inspired imitation, and every failure taught the next generation to innovate. It was in this crucible of ambition and risk that the idea of organized investment, and eventually the stock market itself, began to take shape. The world was learning that money, when multiplied through trust and imagination, could move faster than ships and reshape empires. This was no longer the age of kings and knights. This was the rise of the merchant banker, the quiet ruler of the medieval economy and the architect of the modern financial world. In the heart of the medieval world stood a city like no other, Venice. A city born from the sea, ruled not by kings or conquerors, but by commerce. Here, money was the bloodline that pulsed through marble canals and gilded halls. And it was here, centuries before the modern era, that the first true financial exchange began to take form. Venice was not just a city. It was an idea, a living marketplace floating on water. From dawn until dusk, its docks overflowed with ships from Constantinople, Cairo, and the distant ports of the East. Spices, silks, gold, and glass, treasures that fueled Europe's appetite, all passed through Venetian hands. But it wasn't just goods that made Venice rich. It was information. Venetian merchants were masters of intelligence. They built networks of informants who reported on prices, wars, and weather, the medieval equivalent of financial news. Every whisper mattered. Every rumor could shift fortunes. And soon, trade became something far more sophisticated than barter or exchange. It became speculation. In the 13th century, Venice introduced the colleganza, a revolutionary investment contract. It allowed one investor, often a wealthy merchant, to fund a voyage undertaken by another, the captain or trader. Profits would be shared according to prearranged terms. If the voyage succeeded, both grew richer. If it failed, the loss was shared. This was more than partnership. It was a prototype of the stock investment model. Soon the colleganza evolved into a more complex system. Investors began funding multiple voyages at once, diversifying risk. The same principle that drives modern portfolios today. And with multiple investors involved, they needed a place to meet, trade, and exchange their rights. That place became the Rialto market, the beating heart of Venetian finance. Here, in the shade of arched bridges and crowded courtyards, men in robes debated the fate of ships they would never see. They bought and sold shares in voyages, insurance contracts for cargo, and notes of credit written across distant cities. If you stood there long enough, you could watch the birth of modern finance unfold before your eyes. A system built not on land or armies, but on trust, calculation, and the daring idea that wealth could multiply while you slept. Venice became the financial nerve center of the Mediterranean. Its government, the Serenissima Republic, understood that stability was good for business. So they introduced rules, registries, and early forms of regulation to prevent fraud and maintain public confidence. By the 14th century, Venice even issued state bonds, called prestiti, to fund wars and infrastructure. Citizens could buy these bonds and earn returns from government profits, essentially investing in their own republic. Imagine it, ordinary Venetians standing before marble counters, purchasing fragments of the state itself. the first citizens to ever own a piece of their government's future. In doing so, Venice not only invented financial participation, it also invented the idea that a nation's prosperity could be shared.
The world may have changed, but the game remains the same. What began on the docks of Venice, in the counting houses of Florence, and along the trade routes of Flanders, still echoes through the skyscrapers of Wall Street, the digital screens of the NASDAQ, and the trading apps in our pockets. At its heart, the story of medieval finance is not just about money. It's about trust. Trust between merchants who risks everything on a single voyage. Trust between investors who believed in a promise written on parchment. And trust that the system itself, imperfect as it was, would reward those bold enough to take a chance. That same fragile, powerful trust still governs the financial world today. When we buy a share of a company, when we invest in a startup, or even when we deposit our savings in a bank, we're doing what the merchants of Venice once did. We're placing faith in strangers, in systems, in the invisible hand of commerce, to keep its word. Modern corporations are the descendants of those first merchant partnerships. Each shareholder today mirrors the investors who once funded medieval trading expeditions. The dividends they receive are no different from the profits once shared when a ship returned home safely to port, its hull heavy with silks, spices, and stories. But with that heritage comes the same eternal tension: risk and reward. Medieval merchants understood it well. They knew that a storm could destroy everything, that a pirate's flag could erase months of work. Today, our storms are market crashes, recessions, or digital collapses, invisible forces as unpredictable as the seas once were. Yet still, humanity sails onward, driven by the same desire: to build, to trade, to grow. Capitalism, for all its flaws and contradictions, was not born in boardrooms. It was born in the hearts of merchants who dared to dream beyond their time. They didn't call it capitalism, of course. They called it survival, progress, opportunity. But every risk they took, every ledger they wrote, every coin they lent, paved the path for the world we live in now. When you look at the modern stock exchange, with its flashing numbers, shouting brokers, and instant trades, you're seeing the evolution of a medieval dream. A dream where the wealth of nations could grow not by conquest or kingship, but through collaboration, innovation, and faith in shared prosperity. And perhaps that's the greatest legacy of all. Because while empires have risen and fallen and currencies have changed faces 1,000 times, one truth remains unchanged. Our economy, like our humanity, depends on connection, on the belief that together we can build something greater than ourselves. The merchants of Venice may be gone, but their spirit is not. It lives in every entrepreneur who risks it all for an idea, in every investor who believes in something they cannot yet see, and in every person who, against uncertainty, chooses hope over fear. So, the next time you hear the closing bell of the stock market, imagine a ship returning home, its sails filled with wind, its cargo full of promise. Because that's what it really is, the latest chapter in an ancient story of human ambition, ingenuity, and trust. From medieval docks to modern markets, the tools may have changed, but the purpose endures. To trade, to grow, to believe. This is the true legacy of medieval finance. If you enjoyed uncovering the real roots of capitalism, subscribe to Medieval Finance for more deep dives into the forgotten history of money.